All right, guys. Good morning, everyone. Rainy Saturday here in San Diego. Let's do our usual shout outs. Let's see who's in here. What's going on? Anu, as usual, your name and where you're from, and of course, what you are drinking. All right. And someone let me know really quick if you can see me, hear me, and see my screen. Most importantly is hear me and see my screen. You don't need to see me. But let's see who's in here. I've got my Bird Rock coffee here, one of my favorites, a local place here in San Diego. Anu, what's going on? Justin, how's it going? Richard, of course, from Chicago. He's got the Folgers. I like the instant coffee sometimes, especially with I like to throw a Swiss Miss in there, make it a mocha. Neil, what's going on from Scotland? All right, must be I'm guessing the afternoon over there or evening. Randall, what's going on? He's got the Arnold Palmer tea and lemonade. Sounds good. Uh, Randall, that actually was Randall. Caesar, what's going on? Caesar, we got to get together soon. Donald from Connecticut. Neil's got his Dr. Pepper early in the morning. Got the soda. Although if you're on the East Coast, it's more like lunchtime. Donald, what's going on? Alex from LA drinking the Lavazza dark roast. Uh, Timothy, good morning from Illinois. If I'm saying your name right. Ermias from San Jose has a Starbucks. Justin from British Columbia. Uh, Deval is from West Palm Beach. His own roast. All right. Amin from Atlanta. Lewis from Mexico. All right. Good turnout this morning. Lots to talk about. We're going to do our market analysis. We're going to talk about the rubber band setup because a lot of stocks are setting up right now after deep pullbacks. And then we're going to talk options. A lot of you, I recognize a lot of faces here. You guys know I'm doing an options class starting on Tuesday. And I'm going to send you guys the link here. I think this is the last day. It's 797, but it's 497 today. So if you guys are interested in that, you can click on the link here and join. But we're going to talk some options this morning, a really good strategy going into earnings. So, a lot to talk about, discuss this morning. And as usual, when I'm going through this, if you guys have any questions, just post them in the chat here. And I'm going to put this, you can take a screenshot or just write it down. You guys know you can contact me anytime, whether you're a swing member, I run the swing trading service at Bulls on Wall Street, you're taking the options class, or you come to these stocks and coffees, you're a part of the Bulls family. So you can contact me anytime, singjd1 at AOL.com. Yes, it's the old school AOL. I'm never letting this email go as long as AOL still exists. There's the email. Of course, Bulls on Wall Street, Paul J. Singh, a lot of blog posts on each of these. Today or tomorrow, I'll have some more blog posts on both of these. And these posts that I've linked here are pretty good posts. And of course, Twitter and Instagram. All right, Randall has a question. Oh, not a question, but he's got his vodka in his lemonade. All right, that sounds good. All right, let's get to it. Uh, we all know we've been in a pretty deep pullback here. I've still got my chart up here from one of our entries on Friday, which illustrates the rubber band setup, and we can see what SPY is doing here. Let's go ahead and start with the options. Get the hard stuff out of the way, which actually isn't that hard, as you're going to see as we go through this. Get to our market analysis and a really important setup right now, which is the rubber band setup. So we'll talk all about that. Let's start with the options because Nvidia's earnings are coming up, and what I like to do is generally, if I am going to hold through earnings, I like to either use a pure option strategy, or if I have like my 100 shares, 200 shares, 300 shares, whatever it is of stock, I like to buy insurance going into earnings. If I don't do one of those two things, I'm not going to hold through earnings. You guys know this who are members of the swing report that one of the riskiest times is to hold through earnings when you're swing trading. Because of that, we generally do not enter anything when it's just a straight equity trade, when we're just buying shares. We generally do not enter positions if earnings are in 2 weeks. It's just too volatile. You're essentially gambling through earnings, right? So if we've been holding a really nice setup that maybe we've been holding it for a month and we're sitting on a good profit, but we know earnings are coming up. It's a gamble. Every once in a while, maybe you take a little shot and hold through earnings, but it really is a gamble. You can never predict. And a lot of times, even if the stock does, in terms of what you think it's going to do and reporting its numbers, it's a sell news event and it'll drop. So it really is gambling going into earnings. We don't want to give up our profit, or if we're not in profit yet, we don't want to take a big outsized kind of black swan loss, right? So we always get out. But the beauty of options is there are strategies that allow you to hold through earnings. So that's what we're going to illustrate here today. Now we have, and what we're going to be teaching in the class is a number of strategies around earnings. This is a kind of a protective strategy, essentially creating a stop into earnings for you that mitigates your risk, that limits the risk you take. Whereas if you can have a stop going into earnings with your equity trade, and you can say, I'm only going to risk 10 points, but if the stock gap's down 30 points, you've lost the 30 points, not the 10. This option strategy mitigates that. But we also have some more pure plays with earnings. We have about 7 or 8 different option strategies we're going to talk about related to earnings specifically. One of my favorite plays we're going to go over is the volatility play. Essentially saying, what we just talked about, we don't know on earnings. It's gambling, right? The stock's going to go up big, going to go down big. There are strategies we can use where we can say, I don't know if it's going to go up or down. Maybe it's a huge gap down, maybe it's a huge gap up, but I feel like it's going to be a big move. And regardless of direction, if it's a big move, we can profit from that. And we'll only lose if it's a small move. So there's a number of different strategies. There's earnings run-up strategies that we take advantage of, volatility going into earnings, and that we use spreads for that. So a number of different strategies we're going to talk about. But today, I'm going to introduce the protective put. And I think you guys are going to like this. So even if you don't trade earnings, I would recommend doing this if you want to hold through earnings. So what we're going to do is use NVIDIA as our example. All right. So if we look at NVIDIA here, we can see it has earnings on the 19th, which 15, 16, I think that would be Wednesday, right? Somewhere around there. So we have earnings coming up next week in NVIDIA. So what this does for us is, even if I like the setup, I like the way earnings, NVIDIA has pulled back to the 50-day moving average. Look at this nice piercing pattern here. Very nice setup here. But we didn't enter it, even though it's one of my favorite setups right now, because earnings are coming up. So what you could do is you could enter this, put on the options protective put. Now going into earnings, you don't have to worry. The most you could lose is however the protective put essentially protects you. After that, if it were to gap down deeper, you don't lose anymore. So we'll go over how to do that. Now, what we're going to illustrate today is not that we just entered, but let's say we've been holding this as a kind of a longer term swing setup. Let's say we entered down here. The stock had run up, it had consolidated, it broke the range here. So let's say we entered around here and we've still been holding. We love NVIDIA. It's this nice trend play. We think it's going to keep going higher, so why get out? I'm not going to make it a quick swing. It's more of a position trade. But now earnings are coming up and I've got this big profit, but historically, every once in a while, NVIDIA does gap down big. If we go back here to early 2025, there was a big gap down here where it went down about 20 to 25%. Had a high here of about 150 and it gapped down to 117. So huge gap down here, right? So there's potential for a 25% gap down. Not that it's going to happen, but I wouldn't enter here knowing that maybe there's a 1 in 5 chance that happens, right? So that's a pretty big risk for you. 1 in 5 chance you get like a 25% gap down on earnings. Probably more likely it's going to go up, but still, the 20% chance for a 25% gap down, not good. So we're not going to enter this, but or even hold, because that would give up most of my profit here. But now I know there is a strategy I can use that allows me to hold. So again, I'm going to allow you to hold through earnings. And really quick here, as you guys are watching this, is there anyone in here who uses this strategy or has used it in the past? I'd be interested in knowing, and kind of type out in here how you use it. It allows us to hold through earnings, protected put. Essentially, think of it as insurance. We do have to pay for it. It's not free. When we put a stop in our normal equity trades, it's free, right? We just have our stop. I'm in at one. Maybe I'm using. I was in at 130. Now I'm using a trailing stop. If it goes down to 170, I'm going to get out, right? And there's no cost to do that. But that's not full protection, right? Because we know it could gap down to 150 to 140. Then my 170 stop is meaningless, right? And especially around earnings, those stops become really meaningless because there's a lot of potential for gap downs. So that is why we put in the protective put. That gives me essentially not only a hard stop, but it doesn't take me out. I can still be in it if I want to, and it's just sitting there and I just won't lose more. So I have the protective put in to protect my long position, and it allows me to stay in a stock instead of having to take profits. So if I don't do this, I'm just going to take profits at 190, which is nice. If you were in at 130 and you have 100 shares, it's a $6,000 profit. But we want to stay in it. We want to be in NVIDIA for a longer term trend play. So essentially what we're going to do here is we're going to buy or already have bought, and the way we're doing it now, we already bought 100 shares of a stock. So we'll say NVIDIA. Then all we're going to do is we're going to buy one put for every 100 shares. So you have to trade with even lots to make it exact. So if you have 80 shares of NVIDIA, it's going to be a little different. If you have 150 shares, it's going to be a little different. So if you think you might do this, you probably want to share around 100 share lots, either 100, 200, 300, 400, 500, 1,000, whatever it is, right? And then for every 100 shares, you buy one put to protect it equally. So the example we'll use here, we'll say we have 100 shares, so we only need to buy one put, okay? So we're going to buy 100 shares of the stock, and then we're going to buy one put. Right, Deval. This would be a long put. So you can sell a put or buy a put. We are buying the put or going along the put. So now we're going to buy the put, and then the question is, what is your strike? What strike price are you using for that put? And you can do at the money or slightly out of the money. So, and if you go too far out of the money, you're essentially not getting enough protection. And if you go in the money, it gets too expensive. Remember, we're having to buy this. We're paying for the insurance, right? Just like real insurance, car insurance, life insurance, you're paying for that protection. Same thing here. We're buying the put, we're paying a little bit, but it's worth it to us to pay for it, knowing we're getting that protection in a really volatile time. All right. So we're essentially going to go at the money. And if you don't know what these terms mean, that's okay. We don't have time to explain it right now, but in the class, we'll go over all that. And if you have any questions and you're not in the class, just shoot me a message and I'll let you guys know what all this is. And then if you don't know about the Greeks, that's fine. Again, we'll go over it in the class. At the money is going to be around 0.45 to 0.5 delta. So that's an easy way to look at it, just somewhere in that range. You're going to use a strike or go a little out of the money. Don't go deep out of the money. So when we say out of the money, look at where your support level is, where you think you might want to be stopped out. So here we're entering at 190. We know the range is down here. So about 180 would be a good spot. So that's what we're going to use for our strike. You don't have to use that level, but that's the level we're going to use for this. And then our strike is usually going to be 2 to 4 weeks out. If you have a hard date for an event and you're only putting in that protection for that event, you can even go a little shorter. Like we know the 19th is NVIDIA, so anything past the 19th, but closer than the 2 to 4 weeks would work fine. But in general, somewhere between 2 and 4 weeks out. Now, remember, the farther you go out, the more it's going to cost you. You're paying for that as well when you do an option. So you go on your strike dates, the more expensive it is. Okay, so what we're going to do here is here's an example without NVIDIA, just to illustrate how we do this. Okay, so let's say you have StockX at trading at 100 and you use your strike at 90. So that's about 10 points. Kind of think of it as your floor and where your kind of stop would be. So 10 points here, and it's costing us $3. All right. And it's a 100 share lot. So essentially it's costing us $300. $3 is the option premium. Multiply by that by 100. It's essentially costing you $300. You have 100 shares of the stock that was trading at 100. So it was what would that be, a $10,000 position? And then you're paying 300 for that protection. All right. So when you, sorry, the premium itself is 300. Now, if we think about how much it's going to cost us in terms of what is our stop, you're going to take essentially the width from the stock price to your strike. The stock price is trading at 100. Your strike is 90, so that's 10, right? Add your $3 premium, that's $13, or multiply that by 100, or 1,300. So essentially what you're saying here is you're at 100 on that stock. 87 is what you're protecting yourself to, the strike minus what it cost you, so the $3. So the most you could lose on this is $1,300. So say you're sitting with a $6,000 profit right now on your stock, it's been running. You're sitting on a $6,000 profit. If it gapped down 30 points, you would lose $3,000. But if you have this protective put in, the most you could lose is $1,300. So you can see the kind of protection it's giving you at that point, and you're only paying $300 for it. Now, it does increase your as well, meaning, and that's kind of the insurance you're paying for. Your stock is trading at 100. It needs to go to 103 before you get back to making your normal profit on the stock. And so always add the premium to whatever the stock price is. That's telling you what it has to get above for you to start making profit again. So now that we know how to do it, let's look at real world example with NVIDIA. So again, we know NVIDIA is trading at 190 right now. And let's say we got in at 130. So we bought in right around here where we were talking about, where there was this consolidation back to the 9 EMA, right around 130. So if we got in at 130 a few months ago and it's at 190 now, obviously here 190 minus 130, we're on a 60-point gain or $6,000 profit if we had 100 shares. Okay, so we're sitting on a $6,000 profit. So now what's our strategy going into earnings? Let's say we're just equity traders, but we're just trading without options, and we know earnings are on Wednesday, and we're sitting on that $6,000 profit. And I'm looking at it, and I always look at the history of the stock. And I'm only going back to early 2025 here, but usually I go back like the last 12 quarters. So essentially 2 to 3 years. And I look at all the gap ups and gap downs and get an idea of what best case and worst case scenarios are for gap up versus gap down. And we already see 2025, we had that, it was about a 23% gap down. So if we were to gap down, say 20 to 25% here, we're looking at a potential gap down of about 45 points. So essentially, there's potential here from its past history. Not saying it wouldn't be better or worse, but just knowing the past, we could lose $4,500 here. Meaning my $6,000 profit would go down to $1,500 profit, right? And I don't want that to happen. So I'm willing to pay for a little bit of protection to protect my profit. Maybe now I can make it so if it were to gap down, instead of 6,000, I'm at 4,500 instead of going all the way down to 1,500 in profit. So we can do that by using the protective put. So we still want to hold through earnings. And now look what we're doing. Actually, let's do this and then we'll explain why. So essentially, we're keeping our potential for the gap up and protecting our downside to give us a really outsized risk reward on the future of our holding the stock. So in this case here, we're going to buy one November 28th put. So we're essentially saying we're going out about, was that a week and a half, 2 weeks? November 28th put. It's going to cost us $4. That's what it is right now. It's a little elevated in price because the market knows that earnings are coming up and your options premiums are going to go higher because they know it's a volatile spot. Generally, maybe it usually costs $3. Now it's costing $4. So the November 28th put is around $4 right now, or it's costing me $400 to do. Not bad. I'm sitting on a $6,000 profit right now. I'm willing to pay 400 for the potential to do this, right? And that's what insurance is, right? When we think about life insurance, car insurance, we're willing to pay whatever we pay a year, a month, to get that protection for our car, for our lives, and so on. We're doing the same thing here for our stock. We're paying $400 out of our $6,000 profit to protect ourselves. Notice here, by doing that, remember we add where our stock price is right now and our premium to get our break even. So our break even is now 194. So essentially, the stock is trading at 190. It needs to go up to 194 for me to start making my normal profit again. But it's not limited. It can keep going higher, and I keep making my profit, keep making my profit. It just needs to get above 194. So essentially, that's what I paid for. Paid $400. It makes my break even 194. But now I'm protected. Now my max loss as I hold through earnings is only $1,400, right? The 190 minus the 180. It's trading at 190 right now, minus my 180 strike, plus the $4 I paid, which is 14. Multiply that by 100, $1,400. So now, no matter what this stock does, if it were to gap down 50 points, I would lose $5,000 if I was just equity trading. My $400 protective put now makes it so the most I could ever lose is 1,400. Even if it gapped down 50 points, I still only lose $1,400. So I'm paying for that protection, and hopefully that doesn't happen. I don't lose anything, right? And I gain. And now I still have, so the most I could lose is 1,400. But now let's say it gaps up 50 points, which it has done in the past. Now I make the 5,000 minus the 400 I paid, so 4,400. So think of it this way: I've created a risk reward of $4,400 to $1,400 on the profit I already have. So I could be at 10,000 on this, or I could be down to 4,400 on this, and that's kind of my range of what could happen. I can't lose more than that. So if you're like really thinking of this the way like an institution or a professional trader would trade, this is the way they're thinking. I've protected my downside to 1,400, and I still have this opportunity on the upside. And of course, I've still got my gain that I have, and the lowest my gain could go down to now is 4,400. So you can see how this benefits your risk reward and allows you to stay in a position, still give you this big upside while protecting your risk. And I don't have to worry about a big gap down on earnings anymore. Okay. A note, did I miss anything here? Note, in standard equity trading, we can't do this. You either lose 5,000 or you would end up losing 5,000 if it gapped down that much. So this is the insurance we're paying for. And if you guys have any questions on this, you can message me right now and we'll go over it. So this is one of the strategies around earnings. This is basically just risk reward protection, allowing you to hold through earnings. We have a bunch of other strategies using this our kind of options trading playbook. And essentially everything we go over in this class, we're basically taking our swing strategy and overlaying the right option strategies to use. And I think that's a problem with a lot of people have with options is you can learn all of the option strategies, but there are optimal spots to be using these strategies. And that's what we're doing here in the class. So we have a bunch of stuff we're doing around earnings, again, related to volatility, not just protection like this, but actual trades were based on what the stock does before earnings. There's an earning run-up strategy we use that works very well. And of course, some strategies related to potential gap ups and gap downs. All right, let me see if you guys have any questions. Then we will get to our market analysis and the rubber band setup. Duvall is asking, I'm not sure what size of portfolio means. But yeah, you're right. You have to match your 100 shares with the put. Could you combine to bet on a gap up? There are strategies to do that. Just remember you're essentially increasing your risk. You can use some strategies to limit that risk, but again, you're paying for it. Yes, I mean, every week we have a recording of the stocks and coffee. And I post them in the, it looks like you're a day trading member. I post them in the Discord. Maybe I'll post them in the day trading for you guys who want to see that. Sometimes I feel like if I go into detail day trading and post non-day trading stuff, it might, some people don't want to see that. But I'll go ahead and post that there as well. You're exactly right, Richard. Richard says, so am I right that the protective put offsets the loss if the stock goes against me, uh, but I still make money if the stock goes up? Yeah, that's essentially exactly what it is. You only lose what you paid for on the put. Exactly right. Okay, hopefully you guys found that helpful. Even if you're not taking the class, you can start doing this if you want to trade around earnings. So I would experiment that a little bit, maybe take some paper trades your first few times doing it. All right, let's get to the market now. We know the market has been weak here. If we look at here, notice all of these arrows I have posted here. This has been a fantastic trend since the April low, right? It's been a bit volatile, but nice trend nonetheless. And if we look at the health of the trend, we've seen higher lows, higher highs. Notice this high is higher than the previous high, higher than previous high, higher than previous high, all the way through here. We've had higher high after higher high. And that's combined with higher lows as well. Every one of these kind of volatile pullbacks ended up being higher than the previous one. So that's where we're at right now. Maybe this one, if we use this as a low. But outside of that, has been very strong. Now, notice the character is potentially changing a little bit right now. If we consider this our pivot point, this actually makes a lower high now. You can see this is the first time since April we have a lower high. So what we don't want to see now is that combined with a lower low. So you see this pullback here. We don't want to see this pullback go lower than this pullback here. That would create a combination of a higher low and a lower low. And generally when that happens, we exercise caution and there's potential for a bigger down move and maybe even topping type action. So what we want to see now, and Friday was a great indication of this, is we want to see a hold of the 50-day moving average, which essentially makes it so we don't make a lower low here, and then continuation here. Then we don't have to worry about this so much. And you can see here we had a very strong Friday, maybe closed a little bit weak, but way off the lows, held the 50-day moving average, and we essentially are seeing two major patterns, reversal type patterns in play. If we think of candle patterns, that's when we're pulling back our stocks in a downtrend and we're getting oversold, you get either a piercing pattern like this, where the stock was way down, closes off the lows for the day, and pierces the previous candle here. Or you get something similar, which is a bullish engulfing where it completely envelops the previous candle. These are strong reversal candles, and we are seeing this across the board on a lot of stocks right now. I just had Oracle up, and if I pull up Oracle, we see a good example of that. This would be the piercing pattern that I just drew here, right? Going down, we see that down move, and then we see the stock looking like it was going to continue down, but then recovering and piercing the previous candle. That's exactly what Oracle did here. It looked like it was going to be a bullish engulfing if it would have closed at the high here, but pulled back in a little bit, and we'll call that a piercing pattern here. And we're seeing this type of pattern when you see a hard pullback, and either at extended levels or combined with doing this at a major support level, which you can see Oracle's doing this right at the 200-day moving average. That's a very strong reversal candle. Two ways to play these. One is cautiously play the first day that it happens. Don't do this too much. I only took the Oracle position, didn't add any others, especially with other positions we have on right now. Or wait till the next day for confirmation. If you see this thing start to move off of the previous candle, that's your confirmation. Some traders like to get aggressive and just do it on this day. And then some people will like confirmation. Confirmation, obviously, you're getting in at a little bit of a higher price, but you have that confirmation that it's actually working. So that's what we're seeing a lot of right now. And if we look at SPY, we're seeing some of that. If we look at the Qs here, we see the same pattern, even better. And then IWM here, a strong piercing pattern there. So on the indexes, we're seeing it, and on a bunch of stocks. I'm just going to pull up our main kind of watch list we call the Focus 50. And if we look at this, you're going to just see this pattern. I'm just going to flip through this, and you're going to see a lot of this pattern over and over again. Almost every stock is putting something close, either one of these two things we just talked about, or something close to it. Here's a nice one with Hood, the piercing pattern here. So this is essentially what we're seeing a lot of right now. And it's the go-to kind of play I'm looking at, combined with the rubber band setup. So we're seeing a lot of reversals. Remember, we talked about this in the last Stocks and Coffee, I think. November seasonality is in play. November is one of the strongest months of the year, and combined November, December, strongest 2 months of the year. So we have seasonality in play. This month has started a little bit differently. And remember, seasonality is not the be all end all, but it does give us a little bit of an edge. I think it's 72% of the time over the last 30 years, we've had a positive November. But that does mean 28% of the time it's not positive. But it's an edge that we're watching for. Have that. So that makes it even maybe more likely that these bounces are going to work. Okay, so we know we have these piercing patterns, and we're going to combine this with the setup that we're trading a lot of now, and that is the rubber band setup. Just a quickie explanation of the rubber band setup. That is when a trending stock has not just a regular kind of, when you have these trending stocks, you usually have these tight kind of rate pullbacks here like this. But then at some point, you might get a deep pullback. And what we're looking for is in a strong trending stock, we want to see a deep pullback to a support level and the stock being extended to the downside. And then we get a reversal candle pattern like what we talked about here. So a good measure there's a number of different measures you can use to assess the oversold levels of a stock. One thing is just to eyeball it, and you can see. But if you're looking for an indicator, I like to use the stochastics. And notice here, actually on Hood, it's not that much, but let's look at our Oracle here. You can see Oracle, the stochastics is at 14 right now. Most classical, like technical analysis treatise or books will say a stock is oversold when this number is at 30 or 20. And notice here, Oracle is extremely oversold at 14. And so very oversold, and we can just eyeball it. We don't need an indicator to tell us that, but it's nice to have that indicator confirming what we see with our eyes. And that's essentially the rubber band setup. A strong stock, and we can see Oracle has been a very strong stock, pulls back very deep, very quickly, gets very extended at a support level, puts in that reversal candle. And we see that with Oracle right now. So this is kind of the money setup we're looking for right now. If I was to talk about another setup, which is kind of the opposite of this, we are looking at rubber bands or stocks that have shown relative strength and are breaking out. So IDR is an example of a rubber band. DoorDash, this is a little different setup. VRT, this would be an example of the rubber band setup. And IONQ, another one, example of the rubber band setup. Same with HIMS. Let me look for a relative here. Here's relative strength. NTRA would not be that. This would be a relative strength setup. So that's essentially what you're looking for right now. So going into this week, be on the lookout for the rubber band setups. Look for stocks on your watch list that have been strong stocks that are now pulling back deep and have the characteristics of the rubber band setup for potential entries. Now, that's the equity play. If you're trading options and you understand what this is, the two setups I really like is a debit spread, like doing a long call spread. The problem with that is for this setup, oftentimes when you have something like Oracle, you might be targeted here really high, and your debit spread is going to limit your reward a little bit. It protects you to the downside, but it can limit your reward. I generally will never do a deep out of the money call, but because there's such potential for this thing to make a big move to the upside, Sometimes I'll do a deep, just a straight long call deep out of the money with this. This is one of the only instances I ever do kind of a deep out of the money call. They become very cheap, but you're not likely to win as much. The win rates are very low on these things. That's why it's cheap because it's hard to win. But with these rubber band setups where you expect the stock could explode to the upside, sometimes it's worth doing and you can get in very cheap. And we'll go over more of these strategies and when to implement them in the class on Tuesday. I'm going to post the link again here, and it has all the information on the class. 3 days of essentially teaching the setups, teaching when we should, the swing setups and the option strategy, and then going over a ton of examples. And then there's going to be, and that's Tuesday, Wednesday, Thursday. Then we have on after the holiday, we're going to have a bonus session, a Q&A, and talk about some other stuff. And Kunal's going to come in on a fifth day and go over day trading and using options for day trading as well. So I think you guys are going to like the class. I'm going to post the link in the chat here. And if you have any questions at all, again, contact me here at singjd1@aol.com. You can take a screenshot here or just write down my email. Whether it's about the class, whether it's about swing trading, options, anything you might have questions about, just shoot me a message. I get back to everyone. All right, let's see if you guys have any questions. Otherwise, we'll get out of here and enjoy the rest of our weekend. Yes, there are. I am going to have a recording of this. Mark, yes. Oracle was on Friday. Duval, it's in this it's everything in the class is in here right now, but it'll be 7 the class is going to be 7 Eastern, 4 Pacific, Tuesday, Wednesday, Thursday, and then again after the holiday, after Thanksgiving will be the last 2 classes. There are recordings of it as well. So if you can't attend the class at that time, there's recordings and you have access to me. So even if you can't join the class, I can always jump on if you're having issues outside of the class hours and kind of help you out a little bit. All right. Okay, guys. I'm going to post that link one more time. And again, if you guys have any questions, that's my email. Let me get you the link here. And if it's bullsonwallstreettraders.com /swing options. All right, guys. And we'll be doing probably doing another Stocks and Coffee next Saturday as well. All right, guys. Talk soon.